Hi, everyone. I'm Mark Phillips. I'm the founder of Harvested Financial and the producer of The Tape. I'm also a financial advisor, and because of that, I need to remind you that what we're going to talk about here is not financial advice. It's not a recommendation to buy or sell any securities. It's solely a discussion about the software and intended for educational purposes only. If you have any questions, please visit my website. You'll see the link below, but it's at harvestedfinancial.com, and there you'll find the full terms and conditions. But today, we're here to talk about one of my newest features that I've just deployed called the strip. And it gets its name from the strip of options. It's sort of an old floor term for the list of all the different strikes and a bunch of different indicators and calculations for how markets are pricing those options on the various different strikes. So you have the strip at the various different expirations. And here we can see we have Apple up here, but we have all the different expirations for Apple. So we can go out to February 16th, the 23rd. It does go pretty far out into the future. Kind of a warning just right off the bat, the nearer term calculations are going to be much more relevant. As we go far in advance, some of those probabilities tend to be very dependent on historical data. So we'll focus on some of the near term strikes right now. I'm out at February 16th. And you can see kind of the center column where my eyes tend to go initially is the strike column. So these are all the different strikes in the February 16th expiration for Apple. I've got a delta range filter over here on the left that you can see, we can pull in to only look at the 25 to 80 delta. And so you can just select which kind of strikes you want to focus on, at the money, out of the monies, depending on kind of the different strategy that you're going to be using this strip to construct. The different calculations are very much designed for overlay type positions. A lot of the calculations focus on things we can do with overlays. As we'll see in a minute, the spread builder lets you do a lot of different spreads, but most of the probabilities, while helpful in other different spread constructions, are designed for that overlay, whether it's cash put or covered call type strategy. So the first thing that I'll point out is that the calculations are based on the scenario price. So that's another nice feature of this product, is that you can adjust the scenario price. So right now, the last price that we have snapshotted at the close was $192.11 for Apple. We can adjust the scenario price. We can select the direction and then percentage moves. So 2, 3, 4%. Obviously, you don't think stock's going to sit totally still. Well, maybe you do, and you're putting it on a butterfly. But in general, you're trying to think about what these options might be worth as stock moves up or down over the sort of course of your strategy or the course of your position. So we can figure out what the various long calls are worth if stock were to move up 3%. So if you bought the 182.5 call right now, and it's trading about 11.31, if stock does go up to 197, that call at expiration is going to be worth something like $15, which is about a 36% increase over the $11 that you bought it for right now. We can see that as we get out of the money, stock closes at 197.87. Even the 195 call, you actually lose a bit of money. You pay $337, but that would only be worth about, at expiration, 195 would be $287. Stock closes here. So you lose a little bit. Obviously completely out of the money, you lose your full premium. Same with the long puts. However, if we start going in a scenario down, those puts start to make money. And obviously we can see some of these numbers explode with the whole convexity point about what options will do. If stock tanks and closes down $20 at 172, well, yeah, that 135 put that you bought at the 182 strike is going to be worth quite a bit more, 600% return on capital. We don't really like to trade a lot of naked options, though. Those are sort of more indicative of what the value might do. The cash put and the covered call are really where those overlay users are going to find a lot of value. So how much your position if you were to enter into a covered call. So that assumes you're buying the stock at the current strike price, current stock price, the last price, and selling the call at that strike. So selling the call and buying stock at 192, yeah, you're down $10 on the stock. You probably collected about 11.30 on the call sale. Depending on what all that's worth at the end, that's where that negative 4% comes in. Usually you do an out of the money overwrite, so you get a lot less money for that 195 call if stock's trading 192, so you lose about 8% on both the stock and option position. However, if we start going up instead of down, you can see the different return on capitals for that. So A lot of the earnings from a covered call, I should say a lot of the position value in a covered call comes from the underlying. You are very much long deltas. You want stock to go up. You don't want it to go up much past your strike price, but you want it to go up that amount. And so you can see that even if you're selling the calls for less money, as the strikes get higher, if stock does close higher, those are worth more because you get more of that underlying delta. Cash puts, you collect the premium that you get from those. The more expensive puts you're selling, the more return on capital you're going to get. So that's what that cash put number looks at. At the ends, we have the up and down probability. So this is a historical number. It only looks at the stock price move. It has nothing to do with what the options are saying, but it's a nice comparison against what the options are saying because this is sort of a historical vol calculation, if you will, that we look at what stock returns have done over the past 5 years and we compare that sort of days to expiration. So if we're January 29th looking at the February 16th expiration over the next 16, 18 days, how often does stock move greater than that strike price? So, the move from 192 to 182.5 on the downside happens about 20% of the time. A move of that magnitude in this number of days to expiration. It'll adjust every day with, the days to expiration to go. If you select a daily expiration, there is no calculation because that's an intraday movement type question. So this is only good for anything kind of T+1. But those probabilities are really useful, especially in the cash put. A 25% chance to make 1% a week. That's kind of a good risk calculation that you want to think about if you're selling puts on Apple or any name for that matter, is what's my risk of it hitting? You can compare that to the delta. It actually looks like the delta, one way to interpret delta is an implied probability. The delta, this is the call delta that's listed here. So the put would be the inverse, about 25.3 delta, and the actual realized stock figure there is 24.7. Very close. In something like Apple, we'd expect those to be fairly well in line. As you kind of go out the liquidity spectrum, those might be a little more, there might be a little more variation between those two values. So that can be some interesting opportunities. When we're looking at the markets, one of the other features I added in here was an execution probability. A lot of traders are looking at the markets and you might see it a nickel or a dime wide due to just the technical restrictions of how tight quotes can be. But oftentimes you'll get executed inside that market, particularly if you're putting on a spread trade where you have multiple legs. Those are places that market makers really like to deliver price improvement. And so it's good for the customer too. And what these indicative levels, on a strike by strike basis will tell you is where you can expect to get executed inside the market. And so the bench or the baseline EQ we have defaulted here is 30%. Depending on the liquidity of the issue, roughly on average, market makers, I find, tend to deliver in that 30 to 50% EQ range. So EQ is measured as a distance between the bid and offer. Kind of what's most important to know here is, the midpoint to the bid or the midpoint to the offer. But what's most important to know here is that lower numbers generally mean tighter markets, better for the customer, with 0 being the midpoint. So a 0 EQ means you got perfectly, in between the bid and the offer, which would be a great execution level. But you can use these sort of implied numbers to see maybe how tight the actual markets are and where execution opportunities are. Obviously, that holds a little bit more the higher liquidity name you're looking at, but even in the lower tier names, a lot of the sort of economic forces that are holding those EQ numbers in line are also at play. Kind of below this, I detail some of the use cases of this, how to select the delta range to filter, how to use the return on cash puts, covered calls, some of the outcome prediction with the up and down probability. I get into detail about the exact calculations for some of these metrics, and for the return on capital for both the cash put, what those execution bid and offers are. And then we have the ability to track and plot, as you'll see below. So this is the P&L chart with strike price on the horizontal axis, P&L on the y-axis. For the 192 call, we got to pick something that's actually expiring, maybe a little bit more time. We'll go out to 216 because that's what we were looking at before. So the 192.5 call is worth 455 right now. So if we were to buy that call, one time, we have the classic P&L chart for owning a long call. Our net P&L is negative below the strike price of $455 because that's how much we paid for that call. We can start adding new spreads here though, and we can see what maybe a call spread would look like. So we want to do a tight little call spread, 192, 195, but on the upper leg, I'm going to be selling. I want to make sure my expiration dates are the same. So I'm going to sell that call for $3.37. Now, the most I can make is the difference between the strikes minus the amount I paid. So I'm paying about $1.18 for $2.50 of expansion. 250 minus 118 gives us that net P&L on the upside of 132. 118 we paid, and right between those strikes, going from 192 to 195 is where we start making the money, and that's what that increasing line is. All kinds of fun things you can do with the charting here, though, because we could add a broken wing butterfly or maybe just a regular butterfly. Maybe we'll go all the way up to 200, and we will instead sell 2 of these. So now we have a nice broken wing butterfly. Our risk is actually to the upside in this scenario, but we peak at 195 where we make that max value. We've talked about this in some other videos. Butterflies are hard to capture that max value. But anyway, there are a lot of different things you can do here with these spreads and building sort of custom trades to capture the opportunity that you're seeing based on some of these probabilities and values in the market. Once you have all that, one of the beautiful things you can do with this is track that spread. So you can enter in your email address. You can check to receive SMS alerts instead, only in the US for now. But then you can set the level, an increase or a decrease of a certain percentage threshold, 25, 50, 75%. In the covered call scenario, you might put a call in here. And if that price drops by a certain amount, that would be a good opportunity for you to roll. So, you sell that upside call at $3 and it drops all the way down to $1 due to theta decay. Maybe it's underlying movement also. But if it hits that level, that might be a good signal to start to roll that trade. On the flip side, stop loss alerts, to the extent that it goes up by a certain amount and you're short, that might be an alert you want to put on. So there are a lot of different ways to think about these alerts, both as stop losses, take profits, and roll scenarios. You can enter in a custom name here for what you want to name that spread. So when it comes across, you'll see the 216 butterfly or Jack's favorite income spread. But all of these will come either as you select via email or via text. As far as unsubscribing and managing those alerts, that's all done in the mode which you select. So on your email, you'll see an unsubscribe link, which lets you kind of close that trade, no longer receive alerts for that. Via SMS, you have a couple different options. You'll be able to see a list of all your active alerts, cancel the alerts on a one-by-one basis, or you can cancel all live alerts also. All of that done via the SMS number that you enter. So tracking these spreads, incredibly powerful tool, whether you're just doing overlays with one option, whether you're doing more complicated spreads with multiple options. But being able to set your strike, compare where you're going to get executed, and then track that through its life cycle makes executing these strategies incredibly straightforward and easy, and kind of takes a lot of that monitoring and management out of your hands. So if you have any questions, I'm always open to ideas and feature suggestions. Happy to dig into more detail. There will continue to be more videos here, so please like, subscribe, and follow along here as we build some really cool tools for options traders. Thanks again, and I will see everyone soon.